As industry role players have sought to highlight key factors around home ownership under a mortgage. This includes knowledge around crucial documentation such as a title deed, navigating property sales, and matters around default payments. Other technicalities involve the authority you elect to take on as soon as a bond is transferred into your name. Ooba Home Loan CEO Gavin Lomberg joins us for this discussion. Thank you so much for your time, Gavin. Somebody would say that it's quite obvious if you're still paying a mortgage, the home belongs to the bank, but you have more clarity than I do.
Yeah, thanks for having me. So two important things to note, or two salient points to note. One being when you take on a mortgage, that authority that you elect to take on, as soon as you take on that bond, is transferred in your name. So for avoidance of any doubt, you are the de facto homeowner. It's important to understand that the title deed, though, will only be transferred into your name at settlement of said bond. The bond that is obviously held by the financial services provider you elected, i.e. a bank or some other financial services provider. But any decisions actually linked to the home itself, whether you choose to renovate or extend or decorate or paint or update the landscaping or lease out the property or even sell, that is all your decision, and you are the homeowner for any avoidance of that. The bank is the bond or the mortgage originator owner.
Let's talk more about that in terms of the intricacies that relate to either the letting of that particular property that you are still paying a mortgage on and through a bank, but also the resale of that particular property. How does that work in terms of indicating to the bank as to what it is that you are doing with that property?
So the only time at which you would really engage the bank is on two fronts. One, if you were wanting to renovate and look to seek an advance off the bank to do said renovations, and secondly, if you want to sell, thereby notifying the bank of your intention to settle the existing or the original bond. The bank will then take those proceeds that is still owing, set off the proceeds of the sale against what you still owe them. The net proceeds is obviously for yourself. At that point, the title deed, which is held at the deeds office, will then be transferred into your name as the legitimate homeowner, having settled said bond and having closed the books with the bank.
That makes sense, and the fun part is, of course, settling that particular bond and, getting your hands on that title deed. Talk us through how you navigate that process.
So again, once said property is sold, obviously transfer attorneys will get involved. They will facilitate transfer of that said bond off your name onto the new homeowner's name. The bank will obviously be the middleman. So two banks typically at play, the seller's bank and the buyer's bank. If it's one and the same bank, then so be it. But once those proceeds are settled, you settled your bond with your bond holder bank, and the buyer has secured his bond through his chosen bank, and bond has been granted and transfer has gone through. At the registration and transfer is then done at the deeds office, and the new homeowner then obviously gets hold of said home. That title deed then gets transferred to the new mortgage originator, whether it's the same bank or a new bank, but obviously in the individual's name.
There are also technicalities around settling your bond prior to the stipulated agreement that you entered into with the bank. How then do we deal with that? And what's the easiest way in terms of it being an added advantage, really, as opposed to a con?
Yeah, so early settlement. So two things. I mean, discipline and fiscal discipline, financial discipline in managing your bond repayment is absolutely key. And to the extent, prior to settling, that you can prepay a portion of your bond, the net effect is you pay less interest over time. Typically, bond periods are, granted over 20 or 30 years. Obviously, if you pay it off anytime sooner before that, by default, you are paying less interest to service that bond. So to the degree that you can settle that bond well in advance of the 20 years, it will actually cost you a lot less in total terms, in terms of the original bond amount and the interest accrued over a 20-year period per se versus a 7-year period, if you were to settle your bond within a 7-year period or 10 years or whatever that length of time is. But the big efficiency for you, the homeowner, is long-term cost saving. And it also gives you flexibility in terms of reading market forces. So when it's a buyer's market or a seller's market, to the extent that you've got flexible and you leverage, the value of your home, relative to the market, it can also benefit you in terms of the profit you make off the sale of that property.
As we wrap up this conversation, the timeline of a mortgage and the repayments of it, you referenced what we traditionally know as a 20-year period. Then there is an issue around defaulting on that particular agreement. The issues that would then come up is that you entered into a 20-year agreement, whether you defaulted or not, you expect the expiry of that term to be 20 years. Just maybe clarify how defaulting actually delays the process of reaching the finality of that agreement and how much of a disadvantage it really is, especially on the side of paying interest.
Correct. So again, the longer you have to pay off the bond, the more it's going to cost you effectively by way of repayment. So to the extent that you default, all that merely serves to do is extend the length of the bond repayment, and based on capital and interest, you're going to be a lot more worse off. Key to just state that will always be the last resort of the bondholder, i.e. the bank. The bank will always seek to strike up an agreement that prevents getting to a situation where they've got to sell your home because you've gotten yourself into a level of indebtedness. They will look to reschedule or restructure the debt. They look to renegotiate the loan term. They might propose a payment holiday or rearranging your payment agreement. The last resort would be selling your home from a bank's perspective. So it's in everyone's best interest again. It's probably the single biggest investment anyone makes in their life. And as such, it's key that you exercise fiscal discipline and be as proactive as possible in terms of settling your bond and bond repayments.
Thank you so much for your input. Gavin Lomberg is the CEO at Ooba Home Loans, talking to us about the intricacies of home ownership.